What's up, traders? Just want to take a look at the DXY. You don't have to be an OG to know that the DXY is one of the key indicators that we use to determine the overall trend of the markets. And typically we tend to see an inverse relationship between risk on assets and the dollar itself. And because the majority of commodities are denominated in dollars, we know that a strong dollar is going to mean weak commodity prices, and a weak dollar is going to mean strong commodity prices. So when we start to factor in the potential of ongoing inflation, without paying attention to the fundamentals, we can essentially look at a chart and say, okay, if the DXY continues to strengthen, commodity prices will continue to fall, followed by risk on assets as well. And this will be the reverse wealth effect and help to fight the worldwide inflation that we're currently experiencing. So if you think that inflation is going to come down, we're going to go into some disinflation or deflationary period going into the future, you're expecting a recession or potentially depression, it's very hard for you to draw a case for all that happening without the dollar continuing to strengthen, aka the DXY, or relative strength of the dollar compared to the other basket of currencies. So in the other scenario, we get the opposite. The DXY continues to fall. That means that commodity prices and risk on assets denominated in dollars will continue to rise. And obviously those things have been stoking the inflation fire. If energy continues to get more expensive, whether it's oil, jet fuel, diesel fuel, natural gas, regardless, those things are going to trickle down into all the other things in our life. And more likely than not, we'll see continued inflation going forward. So sure, there's some hypothetical situations we could come up with, and nothing in the markets is certain, but the inverse correlation between the dollar and risk on assets or commodities paints a pretty clear picture of what we could expect. So now that we have an idea of what the results or the effects would be if the dollar strengthens or weakens, let's look at the actual chart and see what's likely to happen and what are some key points to pay attention to. So we can look right at this chart and see there's some key areas of focus that we want to look at. So if we just use our vertical line tool, we know this was clearly a top, and we know we had a top right here as well. And then there's question as to whether or not this is going to be a top. And we'll talk a little bit about that. And then if we just look at our bottoms here as well, we've got a couple of those also. So now we just want to basically go through here and see, okay, in real time, if we were drawing this chart, what would we be looking at? Well, we'd be looking at the high right here, and we would connect it to that high right there and then see what happens. And in this case, we're going to go ahead and turn that one red. So we see we have resistance from the top peak right there, the lower high right there, and then we had a clear resistance here. Once we broke through it, we retested it multiple times, and then we started moving higher. Typically, the reaction you would see with a confirmed breakout. And then what about the bottoms here as well? We're going to take this kind of back here, and then we're just going to kind of connect these other bottoms also. And we'll just turn that green, and we can see that was our bottom here, that was our bottom here, and then this was the bottom from the 1970s. So on this chart, we have about 40 years of DXY. And in this case, we know obviously fiat currencies are designed to go down compared to assets, because essentially as they expand the money supply, there's more money chasing fewer goods or services. Therefore, those goods or services will go up in dollar terms. And that is the actual design of fiat currencies, is for governments to be able to essentially tax through inflation rather than just through legitimate taxes. So if I borrow a bunch of money and there's only two ways I can pay off that debt, either by using the taxes that I get from my people to pay those debts off, or inflating the money supply and then using the newly created money to pay off those debts, essentially devaluing the buying power of that currency or inflating away that debt. So we've been in this downtrend in the dollar relative to other countries' currencies. Now, the majority of this index is actually going to be the euro, but we also have the British pound and the JPY and some other things as well. So we essentially have this descending wedge that we've been inside of for 30 years. And then we have broken out of that wedge. We have found support, and now we're starting to move to the upside. So let's focus now, not as much on this period right here, but let's focus on this little period right here. So we're just going to zoom in a little bit, and let's just take our regular drawing tool and just start connecting some areas and see if we see anything useful. That's not giving us much of information. We would have to basically fall off a cliff before that would actually be useful. So we'll just kind of skip this point right here, and let's try just kind of connecting the next points. Well, here we kind of get a little something going on there, but it's not real clean or anything. So what are some other options? Well, if we grab a parallel channel tool and we go from this peak right here, we can see these peaks are kind of connecting to each other. And then the same thing with the troughs here. So we can kind of move this up and down a little bit and make it perfect. But essentially, this is what I'm looking at. We basically have a peak right here and then a trough. We have a peak right here and then a trough. And then we have a peak right here. So the potential is that we're going to come back down here and retest the bottom of this channel. But right now we have two very clear patterns. We have a descending wedge right here. It's tightening as it goes down. And now we have a breakout of that wedge. And then inside of that, we have this ascending channel right here. So as long as we're operating inside this ascending channel, now that we've broken out of our longer pattern, this is predominantly what is going to determine where the dollar goes based on technical analysis. So we had a very clear downtrend or bear market. And now here we have a series of higher lows and higher highs as well. So it's hard to argue that we're not in a bull market here. So we can use moving averages and some of the other things also, but in this case, we just want to focus on the actual drawing tools. So we broke out of a bearish pattern that's been going on for 30 years. We back tested it multiple times and found support. And now we have created an ascending channel that we're operating inside of. And that bottom was from 2008. So we haven't put in a new lower low since 2008. So for the last 15 years, the dollar has been in a bull market, putting in higher highs and higher lows. So a lot of times people will be a little delusional because something has been taking place for 30 years before that. They don't realize that it's been 15 years since the case has changed. And anyone that looks at this chart and still says the dollar is in a bear market, well, I would love to hear exactly what their reasoning is behind it, because based on technicals, it's just not true. So we broke out of our bearish pattern. We have a bullish pattern now, and we're continuing to the upside. Where is that going to take us next? So the next thing we're going to do is grab our fib tool. So I want to grab from the macro high right here, and I want to take it all the way down to our macro low right there. And we're going to turn this one orange. And then I just want to take off the drawing tools and just make sure it's drawn exactly at the tops and bottoms. There's also a magnet for that as well. And then we're just going to do the same thing one more time, but instead of going from the macro high, we're going to go from this high as well. And then we're still going to take it all the way to the bottom. And then we're going to turn this one yellow. We're just going to go through and clean this up just a little bit by removing some of these bad boys, because we don't really need them to tell us where the highs and lows are now. So we've got our fib from the macro high. We've got our fib from the lower high in 2001. Both of those go down to our macro low from 2008. And now we're just going to pay attention over here to some key areas that we want to focus on. So here we see a clear 236. Here the 382 in yellow and the 236 in orange line up. Here the 618 and 382 line up. Here the 0.5 and 786 line up. So anywhere we have two of those fibs lining up in the same area, we would give extra support or resistance to that area. So we came all the way back up to the 886. So 88.6% of the way back to the previous high. So if we're going to go any higher from here, it's going to be a double tap or a new high. So each time we moved up, we basically consolidated and then we bursted to the upside. So we consolidated around the 236 with a high at the 382, and then we bursted up not one, not two, but three fib levels. And then we consolidated in between the 0.5 and the 618. And then from there, we consolidated long enough. We bursted up from there. So we went from the 618 to the 786 to the 886. And now we came back down and we're consolidating. So this was previously resistance. Once we broke above it, we would expect it to act as support. And a lot of people are looking at this and saying, well, that was a macro top. Now the dollar is going lower. It's going to break back down here and just melt down into nothing. But the truth is, we've been in this bull trend since 2008. So if you want to be bearish on the dollar, you should be bearish from resistance back down to support. And here we have a very, very strong support level in place. So if we just kind of extend this range out right here, it looks very likely that actually we would retest somewhere around like that 98 level if we come down to it. So we have a pretty clear support right here that we're paying attention to with an ascending support line from the channel that we would expect to be an unbreakable low. If we do break down from that, then we would start looking at the measure move of the channel, taking us substantially lower. And then we would pay attention to, hey, do we put in a macro higher low, or do we just take out that low and continue to the downside? And everybody was right. The dollar is being replaced as the world reserve currency. Nobody wants dollars anymore. And the US is going to suffer for all the meanness that they did. But I wouldn't really bet on that. So as far as I'm concerned, my line in the sand is this ascending support and then also the two fibs right here. Let's go down to a shorter time frame and see what's actually happening. So if we just flip over to our daily right here and we just look at the shorter time frame, we'll see we had a nice little run up to the upside and then we came back down. We're starting to find some kind of support, looking for a double bottom scenario. And then we're going to see, are we going to actually test back to the upside or are we going to just continue to the downside? So we're just going to turn on our TJD master on the daily here. We see once we were above the 200 exponential and simple and they were sloped to the upside, they both turned blue. And then we went absolutely parabolic afterwards. And a lot of people this whole way up were calling for the death, the demise, the end of the dollar. And obviously they were completely wrong. And then once we got up here to the peak, we started to correct. The 821 flipped bearish. We see they have flipped red right here. We lost the 200 exponential and simple. And now both of those have flipped red. Now, when we break down from those and we switch from a bull trend to a bear trend, oftentimes what will happen, we see it here when we went from bearish to bullish, we retested 200 exponential, we retested 200 exponential, and then we just go off to the races. Sometimes you'll come back down to the 200 simple, sometimes you won't. In this case, the same thing. We retested the 200 exponential, we retested the lows, and now we're trying to push back up here to retest again. So the real question is, are we going to retest the 200 exponential, get rejected around 104, and then go lower? Are we going to push up here this time and retest the 200 simple at about 106 and then go lower? Or are we going to break through all of this and continue back to the upside? And obviously for now, nobody knows. But what we do see taking place is that the 821 bull cross is back in action. So he basically came back down here. We double bottomed. We have an 821 bull cross. The last time we had one, it retested the 200 exponential and fell short of the 200 simple. So this time we're looking for it to retest the 200 exponential and then potentially the 200 simple as well. So that's the next thing I see. I see the dollar testing to the upside. Now, could the dollar just roll over right here, break down, and go substantially lower? It's definitely a possibility, but oftentimes what the market wants to see is reassurance. So when we break from a bull trend into a bear trend, the market backtests the key 200 exponential and simple moving averages for reassurance, saying, hey, that's not just a fake out. We're going to try to go higher, and then when it fails, we're actually going to go lower. So the same thing was going to happen right here. It's going to want to test up here, and if it can't get above those levels, then it will go lower. The same way with when we hit the bottom right here, we pushed to the upside, and then we came back down to make sure, hey, we don't want to go lower first. So the market has decided we were in a bull trend, and now we're technically in a bear trend. We just want to make sure right here, and then we're going to go lower. But then here we found support again. So now maybe we just need to check one more time and make sure. So in this case, if we just turn the drawing tools back on, what I want to look at right here on the shorter time frames is basically this as a resistance and this as a support. And now as far as I'm concerned, while we're trading in this range between the resistance and support, I would expect support to hold and I would expect resistance to hold. So we have basically two touches on the top right here, a pretty clear line in the sand that lines up with the 200s as well. We have a pretty clear line in the sand right here that lines up with our two bottoms also. So we'll just switch over to our channel tool and we're just going to replicate that same channel. And that's the trading range that we're going to be paying attention to. So whenever an asset is trading inside of a range, we would expect support to hold or resistance to hold until the one time it doesn't. If you're inside of a range, you might touch the bottom of that range 20 times, 50 times, 100 times. Same thing with the top of the range. But you're only ever going to break out one time and then see that continuation to the upside, to the downside. Occasionally, you'll have some breakouts that will fail. You'll go back inside and then the range will continue trading. Whether it's a fake out, whether it's a failed breakout, a throw over, or a spring, doesn't really matter. The fact of the matter is, the majority of the time, you're either going to trade inside of a range or you're going to break out and start trending. Right now, we're trading inside of the range, so that's what I expect to continue happening. So we have the heart line here slightly higher at 103. We have our support down here at 100. We have our resistance here at 106. And in the meantime, those are the key levels I'm watching for. And until one of those levels breaks either to the upside or to the downside, I'm just going to assume this will continue trading inside that range. As long as we're below the 200s though, and they're sloped to the downside, that is technically a bear market on the daily. So we had a nice bull market on the daily, and now we're confirmed into a bear market on the daily. So let's just switch over here real quick to the weekly. And if we look at the weekly, we'll see that the 200 exponential and simple were basically confirmed back to the upside and are still very powerfully confirmed to the upside. And the 200 exponential is on top. So even if we broke out to the upside, back tested the 200 simple, went parabolic, and then came back down, even if we back tested the 200 exponential and simple, as long as they hold and we stay above them, we'll just continue to see higher highs and higher lows on the longer time frames. And that's all we've seen, again, since 2008. So last thing, we just want to go out to the monthly here, and obviously we have the moving average in place, and we'll see very clearly that in the run up from 1980 to 85 or so, the 200 exponential and simple were blue. They were sloped to the upside. That was the end of the bull market. And then here we see a bear market. We attempt to flip back into a bull market, but we never flip the 200 simple back to the upside, back into the bear market. And then here on the monthly, we see that we actually confirm above the 200 exponential, backtest 200 exponential and simple both. 200 exponential is bullish. 200 simple flipped bullish here in 2019. We came back down for a backtest again. Didn't quite get to the 200 simple. And that means that people were bullish on the dollar. We were attempting to come back down and test support. And rather than making it all the way down to the key support to test, people came in and bought up those dollars as quickly as they could at another higher low. And that pushed us up to another higher high. So even if we do come back down here, even if the 821 does get a bear cross, even if we come all the way back to the 200 exponential right here at 94, that's still a higher low compared to these previous two lows right here. And the truth is, even if we broke down and lost those levels, even if we took out the low right here and lost the 200 simple, and then we bottomed somewhere around there in the middle of nowhere, we still have a low and then a high and then a higher low. So I would be very, very careful getting bearish on the dollar anytime while we're still above our monthly 200 exponential and simple, the weekly 200 exponential and simple, and I would pay close attention to the daily 200 exponential and simple. So there we have it. When we turn back on our drawing tools and we pay attention to the big picture, we basically had a very bearish pattern for about 30 years. And in 2008, that changed. So for the last 15 years, the dollar has been bullish. And I don't know how something can be going on for 15 years and people can't admit it when it's as clear as day on the chart. But the fact of the matter is, the dollar is above both its 200s and they're blue. That's a bull market. The dollar is putting in higher highs and higher lows. That's a bull market. So the only thing that could possibly make the dollar any more bullish would be if it was trading at all-time highs. And obviously we have two key resistances to get through before then. So in all reality, when I look at this macro and I see, hey, what's going on here? What's likely to happen going into the future? As long as we're above the 200 exponential and simple, I'm assuming at some point in time, we will retest that previous macro high from 2000 at 120. And if we break through that one at 120, eventually we'll test the previous all-time highs for the dollar. And how can all this take place during de-dollarization? Well, it's basically a giant dollar short squeeze. And I think the best way to look at that is, let's say, for instance, I borrow a Twinkie from you, and Twinkies are worth about $1. Well, let's just say after I borrow that Twinkie from you and I owe you back a Twinkie, I don't owe you $1 because I didn't borrow $1 from you. I borrowed a Twinkie. So then suddenly they no longer make Twinkies. Twinkie goes out of business and they become extremely, extremely difficult to find. The only Twinkies left in existence, because there's no new supply of Twinkies coming online, is the old Twinkies that are in the system. So some people are going to buy those Twinkies and eat them. Other people are going to buy those Twinkies and then sell them to someone else, speculating on the price of those Twinkies. But the fact of the matter is, I have to pay off my debt eventually. So I'm going to need to get a Twinkie. So if I wait until the Twinkie costs $2 or $5 or $10, it doesn't matter. Eventually, I need that Twinkie. So even though I only borrowed one Twinkie from you that was worth $1 at the time, if I take my sweet time to pay you back my debt and I wait until the Twinkie is $10, I don't owe you back $10. I don't owe you back 10 Twinkies. I owe you back one Twinkie, but now the price of that Twinkie is $10. And that is the danger of a dollar short squeeze. Because every time someone pays off a debt that is denominated in dollars, we're destroying dollars that were in the system. So the dollars go away, the debt goes away, and it's a wash. So that means that anyone else that still has debt, there's going to be less availability of supply for them to get a hold of. And that, my friends, is what causes the dollar one day to go parabolic, and probably what ushers in the new system. Because the stronger the dollar gets, the more buying power Americans have, and the more goods and services they'll be purchasing from the rest of the world. So part of the reason that the rest of the world hates the dollar being so strong is because it makes the system very, very difficult. The United States needs to export dollars to the rest of the world so that they have them available. And in doing so, we create larger and larger trade deficits, as we're still exporting goods, but we're also buying more and more goods. So the stronger the dollar is, the more goods we can buy for those dollars. So if and when the dollar does decide to go parabolic, it's going to cause a lot of pain worldwide, but likely that will be the defining moment where we see the powers that be step in and intentionally weaken the dollar or create some new system to alleviate the stress that's being caused by it. And the fact of the matter is, being the world reserve currency is both a blessing and a curse. So yeah, that's it for the DXY today. Obviously, it's very easy to just sit here and say fiat currencies are all going to zero because they print more of them and they inflate the money supply, and that destroys buying power. And that's 100% true. And if you just want to be basic, that's a great way to look at things. But the fact of the matter is, you need to look at the dollar relative to goods and services as well as other currencies. And that's exactly what the DXY does. And the fact of the matter is, the dollar is getting stronger relative to other currencies. So if you're betting against the dollar, just be very, very careful because you're betting against a trend. And the last trend was 30 years down, and we're about 15 years into the uptrend. So I don't know if we're going to have another 15 years of bullishness, but one of the most difficult things to do is pick tops and pick bottoms. So whether you're looking at the fundamentals or the technicals, the fact of the matter is, right now, you should be bullish on DXY. So yeah, that's it for today. Just want to talk about the DXY and just kind of like smack down some of the rumors, some of the talks, some of the FUD. The dollar is strong. The world is not de-dollarizing, at least not anywhere near the levels that anyone should be worried. The dollar will continue to be the world reserve currency for another year or 5 or 10 or 20 or 50. We're not going to see something come up overnight and replace the dollar unless the system breaks. So before you start betting on the end of the dollar and the end of the current system, I'd do a little research on the Lindy effect, because the hardest thing to do is timing the move. Everyone knows that fiat currencies are not going to last forever, but there's a reason that people refer to the JPY trade as the widowmaker. So yeah, that's it for today. Just want to remind you, that's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So that was fun. It's always a good time breaking down the dollar. Hopefully you enjoyed it as well. If you did, make sure to like and subscribe. But yeah, I'm out of here, Crypto Trend Trader, and I'll catch you on the flip side.